Welcome back to New Money. This evening we're discussing investments, and I forgot to mention at the start of the program that my guest is David Shapiro, but I gather you understand that now. And if you'd like to email or send inquiries, you can do so. My details will appear on the screen. David, let's talk about second quarter GDP, 0.8%. Do we now multiply that by 4 and say expected GDP for the year 3.2%?
No, that's 0.8% annualized. So it's quite technical how they work it out, but we're still likely to grow less than 1% for the year. But it's this reading was slightly better than the market expected. Mining contributing. Bryan, 0.8 is a decimal point. It's still far too low for an economy like ours, where we have such high unemployment, such high debt, that we have to try and bring down. So I don't think at these levels it's conducive to any major change in the economy.
Yeah.
A lot of work has to be done. And no one's listening. I don't want to get frustrated. I don't want to get angry. But we need far higher levels to actually address our unemployment and address the issues, the structural issues that are taking us down. We haven't got money. That's a big point.
I'll deal with that in the email in a moment. But David, it's amazing how many emails I get when people know you're on my program with me. But I've got an email from Bryan Mslange says, many commentators are very negative, suggesting that the market has run too hard. I'm heavily invested in the S&P and NASDAQ, and I don't want to reduce my holdings because of capital gains tax. Should I consider buying a hedge, or would it be better to hold on and ride out a possible market correction?
Yeah, hedges are expensive. And if you're going to hedge, you've got to hedge your whole portfolio, which becomes incredibly difficult to do. Because,
yes, and your portfolio's got to be hedged against a particular index.
What do you do? You've got to, if you've got a 5% hedge or a 10%, it doesn't really make much difference. If you believe it's overpriced, you can take a little bit of cash. Bryan, I think virtually, if you're reading this weekend, and I do it regularly, I like to read all the financial publications. There's so many commentators now calling this market a bubble. And I think it happens whenever the market runs as hard as it has. From my point of view, I still think that AI is still the only game in town. I'm talking about technology. And it just dominates our life, in every respect. I can't talk, I can go on for a half an hour about all of this, but to try and just, bring it down to a quick answer, I still think huge amounts of money are going into the market. As rates come down, which we've just spoken about, I think it's going to give the market another lift as well. Yes, it does mean that some of these companies are being stretched, their valuations are stretched, but they're still operating well, they're still making big profit, and they're still in very strong condition. The fact that the market's moving them up is not their fault. Even if the price comes down, they're still strong companies. So my view is to ride it out a little longer. I think we're going to be, this is, AI and the development of AI is going to, and all the different, parts to it, I think are going to be with us for some time. But I think after the kind of run that we've seen, you can expect some kind of a correction down the line. It doesn't mean that it's the end of the, of the strategy, of the topic, of the,
So David, I also, like you, do a lot of reading, and I sometimes remember some things, sometimes I think I remember. But the one statistics I found absolutely amazing. In 2022, $74 billion was spent on AI development. This year, $454 billion. Are those figures right?
Yes.
That's sixfold.
Yeah, but Bryan, it's a totally different strategy. This is not the internet. You have to roll out the infrastructure. You have to build these massive data centers and equip those data centers, because without it, you can't get the benefit of artificial intelligence, of these large language models. So you need that infrastructure for this to work. So if you stop spending, well then it's not going to work, if you cut it down. And that's a danger. I always look at it like the old cowboy movies that we used to watch, when you were young, when I was young. We used to go down to the Lake Bioscope on a Saturday morning
Lovely.
and watch cowboy movies.
Lovely. The stagecoach always got held up.
Yeah, but they were expanding the West, and that's exactly right. And they were building the railways, and that not everybody benefited, but that whole railways going out there eventually did bring growth, to the entire US economy. And I think we're in the same kind of situation now. We can't tell who the winners and who the losers are going to be. But at least we're rolling these out. People are taking risk, and if they don't take risk, they're not going to get return.
David, just share, when I talked about that money, 454 billion, somewhere around there, where's the money being spent? You spoke in data centers. Yeah. I mean, who are these? If someone wanted to invest in AI, there's a whole range of different components you could invest in.
Yeah, exactly. If you go to the OR Tambo, if you go, I think it's R27, on the right, there's a Wilson Bailey building that's being built. I don't know where it is now. It could be complete. It looks like a massive warehouse. Massive. That's a data center. So it's not just a little container on the side of the road with a few computers inside. These are big constructions. And this is just one. Can you imagine how much is needed? But for AI to be a success, you need massive data and you need very, very fast processing. Over and above that, you need electricity to drive these centers. So I think this is the beauty of it. The first phase is actually setting up the infrastructure. After that, we can start to use it. Of course, there are going to be failures along the line, and that depends on the business. And, businesses will decide, do we do it or don't? If you don't do it, you can fall behind your competitors. So I think it's a very exciting time, but I think one has to be realistic. Yes, there are going to be some companies that don't quite make it or fall by the wayside. In the meantime, it's being dominated by the businesses we know.
But David, is there no possibility that someone will build a data center to house all this and then rent out space to the different organizations, that they don't have to buy and develop their own data centers?
I think you're doing that already. I think that is already happening with cloud. You don't need your own factory, for example. You can rent other factories. So it's quite complicated. But the point is now, you'll see that Mr. Trump is going off to the UK and he's taking with him Jensen Huang from NVIDIA. The whole point is for NVIDIA to try and get contracts for data centers in the UK. Every country is going to have to build their own factories as such. And eventually, probably each business will have their own data factory, where they store all their data offline in the cloud, whatever it is. But, where you're using the numbers in order to prove efficiencies and keep your businesses going.
Okay, let's get back to the emails, Dave. Stan in Saxonwell said, with Washington printing trillions of dollars, is everyone starting to dump the dollar?
Yes, we spoke about that earlier. That's exactly why. Because there are concerns about the US economy. Sometimes I think they might be overstated. And also, I think there are a lot of countries that don't want to be beholden to the dollar as their reserve currencies, and that's why you've seen the shift to gold, the shift to other currencies. It has been to an extent anti-American from 2 points of view, politically and perhaps on the economic or financial side as well. Where does it stop? I don't know. I'm very bullish on America. I just think because they've got the skills and they've got the money and they've got the dynamism, they have, and they will continue to grow perhaps faster than any other economy. And I think down the line that will draw money back into the US at some stage, and perhaps start to reverse what we've been seeing now.
David Martin in Greenspan asks, please explain what you as an active manager do as compared to me buying passive index funds.
That's quite interesting, because active can mean anything. It means somebody who's not buying a passive index. My view is that I'm active in the sense that I like to buy the top companies. So if you look at my portfolios, I've got the top end of the S&P. I will buy all those tech stocks. Also maybe adding a few stocks that dominate the indices in Europe and so on. But not everybody does that. So why do I do that? Is that once you buy an index, you're actually diluting your holdings. You're spreading it over a lot more companies that might underperform. So that's my approach. I like to say, okay, what are the best companies in the index? Let's buy those. Are they still relevant? But it's a good question, and I think to everybody out there, you've got to check whether your active manager is actually active. Whether he's improving or beating the top end of the market, the S&P or the whatever else, the Nasdaq, the FTSE, whatever.
Yeah, but David, those indexes, those indexes are run by those top few companies which you buy. But then obviously you can't be overly exposed like an index fund. What you've got to do is also buy other quality companies that may not perform as well in the short term, but have good prospects going forward, which then may reduce the comparison of a performance in a portfolio held by you compared to the risks you take by being so overexposed to an index fund.
You see, for example, if you take the S&P 500 at the moment and you bring up a very relevant point, if you buy the S&P at the moment, you're buying the top 10 shares that you're buying in that index make up 40% of the index. If you buy the top 20 in the S&P make up 60% of the index. So you're very overweight to the Nvidias, to the Teslas, to the Broadcoms, to all of those businesses without really knowing it. So you've actually increased your risk profile by buying the S&P. I wish we could illustrate this with charts and that. It's very difficult numbers.
Dave, you'll be on with me in a few months' time when you're back.
Yes.
Let's do that. But now it's now almost 5 months since Liberation Day massacre.
Yes.
How did you as viewers at the time feel when markets fell? It's remarkable how quickly investors can shift from suffocating fear and panic to complacency, cautious optimism, and even bullish settlement. It is important to remember that every crisis is different, and each one can feel as though it might be the big one. That is why it's essential to think long-term and accept that you will likely feel anxious again when markets do correct, because inevitably they will. History has consistently shown, however, that those who remain patient and even start buying when markets are down rather than selling ultimately benefit from the asset class. David, thank you for joining me this evening. It's important to note that our program is to provide information and should not be construed as advice. Next week's program we're dealing with healthcare, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.